What's up, guys? This is Casey, and welcome back to the channel. So we have a lot to unpack today. Today, I want to talk to you guys about the stocks, particularly the bank stocks, why they've been dropping significantly over the past few days, and why I do not think that we're out of the woodworks yet. I think there's going to be a lot more downside to come, particularly with this recession. I want to talk to you and tell you exactly why. So let's just going to hop into this. So first things first, over the past few days, not only the regional banks, but the major national banks have been falling significantly. Charles Schwab, Bank of America, Credit Suisse, also JP Morgan, and Wells Fargo. And a lot of people are worried that the contagion risk is going to continue to spread to not only the regional banks, but to the larger national banks. Charles Schwab has been down over 12%, even as the firm defends financial position. We have Bank of America has been down significantly, so much so to where people are now concerned that Bank of America is going to be the large bank that causes issues, aka the WorldCom back in the 2000s. We have Credit Suisse that has been down significantly, much more so than most of the other banks. And this is one of the banks that I think we have one of the biggest concerns with because not only are they down significantly, but one of the biggest investors and backers, the Saudis, have pulled out and said that they are no longer going to back the bank. This has then prompted the government of Switzerland to step in and say that we are going to go ahead and offer some financing if they need it. And you know what? The bank, Credit Suisse, actually took them up. And so they borrowed more than $50 billion after their stocks crashed 30%. And they said here in the article that they did this just not because they needed to, but just to show the public and to show that they have much more needed liquidity than what's actually required to be healthy. I call BS on this. Companies and banks do not borrow significant cash flows for reserves unless they need it. If you think back in the 2008, if I'm not mistaken, the Lehman Brothers CEO had gotten on television just a few days before. I think it was national TV, and they were asking what was the health of his company, of the bank, and he's, oh yeah, we're doing great, everything's fine. And then literally 48 hours later, it's like the doors were shut and people were walking out with the boxes and stuff. They're not ever going to tell you when there's a real significant issue, and that's because a lot of the banking industry is built on trust and it's built on confidence. Think about what an actual bank run is. It's that once people stop feeling as though that their money is protected, well, then they just all want to take it out. And if enough people do that, then we're going to have a big problem here because at that point, the entire system collapses. And that's why you have situations like this to where the government of Switzerland or you have our federal government steps in and they say, hey, we're going to go and insure deposits because we want to make sure that you guys know that even if the banks themselves make silly investment decisions or gambling decisions, we, the government, will back it. We will ensure that your funds are protected. So looking at Charles Schwab here, they have dropped significantly, much more than 12% over the past few days. They have had a slight rebound, but nothing significant to actually kind of talk about. If you look at Bank of America is like just falling like you wouldn't believe right now. And this is concerning because Bank of America is one of the largest banks. Now, if you take a look at Bank of America, what people are doing is they are comparing the top banks to SIVB on their balance sheets and trying to identify what are the similarities and what are the differences. And let's kind of go over a few of those very high level. Don't let this snapshot or screenshot intimidate you and kind of overthink it. It's just very simple. The bottom line is this, that SIVB Bank had a lot of what are called HTMs, which are held to maturity bonds, basically saying they went and they bought a lot of bonds that didn't mature until like 10 years is when they could take their money out. But and you generally assume that they're safe, but the money's tied up, but they're not. They started to go down significantly, in addition to people then having to run on the bank. And so they didn't have the bond equity to cover the cost of the runs on the bank, and then they went under. Now, if you take a look at JP Morgan, Bank of America, and Wells Fargo, you'll see here that the FMV, which is the fair market value of the bonds that they're holding, has also gone down significantly, but nothing like SIVB, hence the collapse. SIVB was at 123%. The next closest with the largest banks are Bank of America. 44% is significant when you think about it. Over half of their long-term held to market, long-term investments, or it's almost lost 50%. But the significant difference between Bank of America and SIVB is their total assets. SIVB 210 billion, Bank of America 3 T's, and I'm talking about 3 trillion. They are huge. Okay, so if you take a look at this, this is a significant reason why, although their market values have fallen significantly, they still have the cash flows right now to actually support and hold on to this. Now, what this means, though, that this does not mean the Bank of America is out of the woods, meaning that if the Federal Reserve continues to raise rates, we may continue to see additional banks collapse. And this is exactly what the Federal Reserve is trying to weigh right now in their upcoming meeting. As a matter of fact, they had an emergency meeting Monday to discuss the overall healthy states of the banks, the entire healthy state of the financial networks internationally, to identify if by raising rates a half of a percent or a quarter of a percent, would that have a detrimental impact, or would just some of the weak banks fall and then the stronger ones can still withstand it? And the reason they did that is because they needed to understand the actual assets and the actual risk that these banks have. And I'm sure that they sat down in that meeting and discussed and went over with some of the CEOs and executives of these banks. Because right now, the Federal Reserve is in a very tough position. They're in a position where they are trying to curb inflation. And inflation is so important to get down, because if they don't get that down, what's going to happen is the cost of rent is going to continue to go up, the cost of cars, the cost of gas, and salaries are just not going to go up and match the cost of inflation. We're at like 6-7% right now. I believe last month's inflationary report showed, and so we're still extremely high, much more than where we want to actually be. And the Federal Reserve knows that they have to get it down. It's the equivalent of like an engine that's running hot. You can only run hot for so long before something breaks. And so they're like, well, listen, we have to pump in some coolant, if you will, to kind of get the engine cool. But the problem with this is that it's causing it may cause issues with other parts around it. And so they're in a very tight position. Do they not raise rates to not put more pressure on the banks who are in a weakened financial state because they've over leveraged and over invested and didn't manage their investments correctly? Or do they say, okay, well, we need to raise the rates because if we don't, then a gallon of milk is going to be $10 in a couple of years? So they have a really tough decision. If you ask me, I do think that the Federal Reserve is going to raise by a quarter basis points. I don't think that they're going to do a half, but I do think they're going to do a quarter. The only situation in which I think that they're going to do a half is if they find out that the job reports are really strong, which in essence, the last job report showed that they were. And if you remember, the Federal Reserve came out last month, Chairman Powell, when he testified before Congress, and it pretty much said that, it's stronger than what they anticipated and that they are going to make more aggressive raises and hikes in order to get inflation down. And then literally like the next week is when all this broke loose. So now they're in a very tight position, but I do think it's one of those to where they're going to have to make a decision, and they're going to have to do it very quickly. Let's take a look at some of the banks and take a look at the percentages that they've been down as of late. So as you can take a look here, Swiss, however you say it, 6 months, it's down 60%. I mean, that's insane. Let's take a look at, we have Charles Schwab. Charles Schwab is down. They have lost half of their market value in literally 30 days. I mean, this is Charles Schwab here, people. A very stable, respectable company, but, it's looking a little shaky right now. Bank of America is down 20%. Now, keep in mind, these are major, massive banks. But look at it this way: the bank that collapsed was roughly the same market cap size of, BAC, which is very weird when you think about it. Now, let's take a look also at JP Morgan. JP Morgan, $377 billion. I mean, these companies all have significant market cap sizes, and they are down a lot. Now JP Morgan, not so much. They are down over a month, over 10%. But when you think about the overall instability of the markets, that's pretty significant. Now Jim Cramer got on, he posted on his channel that on his stock, what do you call it, his channel or his feed, if you will, that, as he says, as the bank crisis spreads, that he thinks that the Fed's going to need to take drastic measures. what this means is that Jim Cramer wants the Federal Reserve to not only not raise heights, but maybe even start to drop them. And so he wants actual, not tightening, but he wants actual loosening to take place. I think that would be a huge mistake because while this is going to put some pressure on the banks by continuing to raise rates, you have to figure out which one's worse right now. And it's kind of between a rock and a hard place. Now, do I think that a lot of the large banks are in healthy positions? Yes, I do. And so I think the Federal Reserve has to make decisions in order to decide which one is going to make more sense. And I think that's going to be getting inflation down because it just cannot continue to run hot. So Jim Cramer wants the Fed to flat out not raise any rates. I don't think that's going to happen because if it does, it's just going to be crap. So 538, they released an article asking, what does the Silicon Valley Bank collapse mean for overall the economy? Well, one of the actual transcripts in the article says that, the bank that failed is the second largest bank failure in the U.S. history. So a lot of people have not been comparing it to 2008 saying this is different, but this article pretty much says, well, how is it different? Because a lot of the similarities of the behaviors and characteristics of the bank failures are the same. They've over leveraged, they got caught in a higher interest rates that took place, and now they are collapsing. And generally, what you see in these types of things is that the smaller banks will start to go first, and then you generally will have kind of like a WorldCom that'll just shock people out of nowhere. You'll wake up Monday morning or Wednesday, Friday, whenever, and then you'll see that a big, huge bank will come across your news headlines saying that they now are in brink of collapse. And then generally, that's the last time it'll fall, and then everything else just kind of hits the wall. So if you take a look here also, there's a lot of articles right now. One of them is this what CNN released stating that there's still a lot of fear in the global markets, so much so to where one of the former Goldman Sachs CEOs, he says that they failed because of diversity. He says it's laughable. We have a lot of the CEOs that have been going through, based on this article, saying that they are now purchasing the stocks with these drops, trying to instill more confidence in the markets. I think that's something that a CEO should do just because that's what it shows that they have confidence in their company. But I think it's only a small gesture. I don't necessarily think that it's something that is a true big gesture that points to showing that they have a lot of confidence, even if the banks that they manage, were in unhealthy conditions. I don't think that they would necessarily say that. Now, Michael Burry. I was going to say Michael Berry with the E instead of a U. So this is weird because if you guys remember him, he is from the short video back in 2008. That got released to where he took a big hit on the real estate market falling. He took a lot of huge hedge investments of billions of dollars. People thought that it was crazy. It's like, okay, you really want to go do this? I mean, the real estate markets never crashed before. You want to take out all these bonds that says all these investments that say it's going to crash. It crashed. He became very rich. It made a lot of people very rich. Well, over the past few days, he has been making comments saying that he believes that it's like 2008 and 2023 is very similar, and he's just kind of going in on them. Then all of a sudden, he pulls a 180. And now he's saying that, oh, the crisis is resolved very quickly. I'm not seeing true danger here. And it's just like there is something very, I don't want to say inauthentic, but the tone is not consistent between this and the 13th and then this. Oh, resolved very quickly. Oh, nothing to see here, guys. Walk away. Something is very different now. Did some people put a bug in his ear and say, "Listen, you better stop instilling fear"? We're not playing. I don't know. Or maybe this is what he actually thought, but then he saw that all of the funds and the influx and the backing of the federal government, because they did move very quickly to back a lot of the deposits. Maybe that just kind of got rid of his concern. I don't exactly know, but it's a very odd tone because he has been one of the main people on social media who is just thinking that this stuff is about to explode. As a matter of fact, he released a tweet, I believe, last month that just pretty much said, now we're just waiting for the next WorldCom. If you don't remember, WorldCom is a bank back in the day that had some very questionable financial practices. They were conflating their actual profits and their revenues. And then when it came time to pay the piper, they didn't have the money, they went under. So I don't know which one to believe here. Does he really believe that things are resolved quickly, or is he just doing this so that he can instill some fear in he can instill some non-fear in the markets? Or, who really knows? But here's what I do know. I want you guys to keep your head on the swivel. I want you guys to be smart and be safe. I would not go out here right now and do a ton of investing, but I also, at the same time, wouldn't go out here and just start pulling your money out of the banking systems. I would not do that for a number of reasons. You have to remember, at the end of the day, the Federal Reserve is going to do any and everything necessary to ensure that our financial systems do not collapse. You have to understand that the financial systems are literally the backing of us as a society. So, irrespective of how many tweets or Twitter links, whatever it is you see online of people, yelling out doom and gloom. Up to this point in our society, we haven't really had that. Yes, we've had the Great Depression that took place over a number of years. Yes, we've had a lot of the tulip manias, and we have lots of bubbles that take place. That is common in economics, that is common in economies because, as you all know, human nature, fear, and greed. And so ultimately, when one of those two things really meet extremes, something has to give. And so right now, we're kind of in the fear state, but I think that this is more of a recalibration, if you will, as a result of all of the greed and all of the money that we've had and the influx and the inflows over the past few years as a result of the pandemic and what have you. So do I think that we're out of the woods yet? Not by a long shot. I think that we are in a position to where this is just kind of a slight bounce before we start to see more. You have to remember that in an actual recession, you generally see very volatile moves to the upside after very volatile moves to the downside, because that's a lot of people who are covering shorts, and it's a lot of people who are trying to just hop in to get a quick buck, and then they're going to jump back out again. Banks generally don't move this volatile. And so when they do, the whales, the people with the big money, the billionaires, the hedge funds, the private equity, the private wealth, those people know something. And so if you really want to know where we're going to be headed, follow the money, follow the markets, but at the same time, be safe, be responsible, and don't panic. You have to remember that most of the time, people make most of the money when in recessions. And how often do recessions occur? Very, very rarely. If you guys have followed my last videos, you know that the last time we've had a recession was 2008, before that 2000. So we are talking in the last 23 years, going on 24 years, we have had two recessions. That is on average once every 8 years. If you give or take, 7 years, it's just not, well, 7 years between 2000 and 2008. We're now going on 14 years, actually 15 years now, since we've last had one. So I do not think that this is over. I think this is the beginning before we're going to continue to have a lot more downfall. If you do want to invest, do so very gently. Buy some of the stocks that you have a lot of confidence in, like some of the ETFs, buy some of the QQQs, maybe put 10 to 15% of your cash reserves in the markets if you're comfortable doing that right now. But I do think there are going to be other opportunities here in the next 3 to 9 to 12 months, if you will, for us to really take advantage of a lot more dips. So keep your head on a swivel. Make sure you guys just kind of stay tuned. If you haven't already, please make sure that you like and subscribe to the channel. If you're not aware, we are a financial education channel. We also have been keeping very close tabs of these banking crises, because this is something that we all are just trying to keep up to breast on. And I want to keep you guys updated with the latest information as it comes out. So if you got to the end of the video, thank you so much for watching. Please make sure to like, subscribe, leave a comment below as well. I want to know, do you guys think, are we out of this? Do you think that this is kind of the last, and by the end of the year, we're just going to go back and say a couple of banks failed and that's it? Or do you think that this is the start of something much more grander in terms of a recession? So thanks so much for watching. Be safe. Talk to you later.